I'm Peter Gelman of Palmerston Group Advisors. Over the years, I've noticed that financial planning for business owners can be less than ideal, and I think when things aren't working optimally, three factors often are involved. First, financial advisors are not often trained to get too deeply into tax planning, and the financial planning training or education a financial advisor receives tilts towards personal finances. To be sure, there are lots of specialized topics which good planners are familiar with or sometimes specialize in, but the training or experience may be limited when it comes to helping business owners with their businesses. When wealth reaches a certain level, taxation, really the erosion of wealth because of taxes, becomes a huge issue. Many business owners already know that point instinctively, and they're frustrated about it. Keeping money from being taxed away is the issue where business owners sometimes find that they lose control. And that can mean the loss of money year after year after year. In particular, when a business owner breaks through to the next level of success, that breakthrough can bring all kinds of challenges with it. Greater tax liabilities, succession and estate planning, key employees and larger workforces to invest in, significant charitable opportunities. Basically, all kinds of new or more complex planning issues. To top it off, making the next incremental after-tax dollar is always a big challenge. The business owner usually has to invest capital before there's a chance to earn it. That means something like launching a new product or service offering, or finding a new distribution channel for an existing product. Planning, on the other hand, mitigates taxes on profits already earned or about to be earned. So that means more money in the pocket without a new investment of capital. My own experience serving successful business owners has taught me that the task of keeping money through proactive, specialized planning is frequently at least as important as personal investment and portfolio management. Second, planning for business owners often has too many silos, and it frequently lacks a team-based approach. Business owners may have a financial advisor, a corporate attorney, an estate planning attorney, and at least one CPA, sometimes more than that. Although these experts speak to one another, it's rarely enough, and it's even rarer that one of those advisors acts as a quarterback and coordinates the various channels of advice on behalf of the business owner. A lot of the time, there's not much team-based collaboration, and the onus of any coordination falls on the shoulders of an already very busy business owner. Hence, the advisors the owners usually rely on usually are operating in their own isolated silos. And this isolation is even more challenging because these professionals tend to focus pretty narrowly within their own fields. The business owner may need additional different kinds of expertise in accounting or law, but in the real world, her advisors don't have the time to be that broad. For example, a very good CPA who is strong on tax planning may not have much experience in an area like cost segregation or tax planning around creating non-qualified plans. Or a strong estate planning lawyer may not be deeply familiar with business succession planning strategies. Successful business owners will benefit from a highly customized team of experts. It should be a process where one of the advisors, manages the team, and also a process where the planning integrates personal and business issues. If they don't have a team-based approach in place, there's a risk that they're being underserved. Third, and finally, when it comes to investing, successful business owners and financial advisors sometimes are on different planets. What do I mean by that? If financial planners are thinking in conventional terms, they're thinking about asset allocation in terms of stocks and bonds and index funds and Roth IRAs and traditional IRAs, etc., etc. The plans and investing strategies usually created by financial advisors are aiming to achieve returns of 5%, 7%, 9%. Undoubtedly, as advisors, we hope for some home runs leading to even more. But based on the marketable securities advisors usually have to choose from, there are real ceilings on what clients should expect and what advisors should tell clients to expect. In contrast, a successful business owner can potentially earn much higher returns on the capital being invested in that successful business. That is superior capital allocation. Plus, there are often planning opportunities available within the business or within a set of related business entities, which result in lower tax rates and much higher after-tax returns. The returns on invested capital, including reinvested profits, could be 25% or 50% or higher, returns that are multiples of conventional investment returns. These are the two planets. Good planning for business owners needs to start there. It needs to amplify and build on the unique opportunity represented by huge, way above average returns on capital that a great business enjoys. Therefore, reallocating capital away from a great business can be very costly. Now, it often makes sense to take some winnings off the table, just in case something goes wrong. But that's a very different analysis. Just think about an owner whose business is earning 30% on its use of capital. $1 of profit from that business leaving for a conventional investment like a stock or bond very probably is going to make a lot less money. It may be diversification, but it's also diversification. The purpose of diversification needs to be safety, but there needs to be an acknowledgement that financial reward is being sacrificed for that goal. The bottom line here is that financial planning needs to be highly focused on the unique opportunities created by the business, and only secondarily on the conventional planning and investment issues which normally deserve the attention. This failure to shift focus, where the advisor continues to treat the business owner's case as a normal financial situation, is why business owners sometimes don't get the advice, the normal advisory focus that they need. The shift has to be away from personal finances toward the business, and it's different from personal finances, even high net worth personal finances. Second, business owners need teams of experts rather than silos. And third, returns on invested capital tend to be much, much higher inside a successful business, and planning needs to reflect that fact. Keep those three things in mind when you think about planning for business owners. Thanks for watching.